my name is Eric, and we have a problem over here. A problem. So, you have two bonds. They were issued by two banks. Bond A has a term, well, they both have a term of 1 year. Bond A has a coupon rate of 15%. Bond B has a coupon rate of 10%. Bond A, they both have a par value of $100, and Bond A's price was already determined to be $100. And now Bond B needs to also determine its price so that it can be comparable to A, so that it is not clear which one is better, so that each of them can be bought. Okay, so when I first looked at this problem, I thought, well, what do you get from Bond A? Well, after 1 year, you're going to get $115. So you have $115 minus your price, which you paid, which is $100, and you would have a profit of, sorry, you don't have a profit of $15. You have a profit of $100. You have a profit of $15. So, and then I thought maybe you should have a profit of $15 for Bond B as well. So, if you look here, you would get $110 which, at the end of the year, which means that maybe the price should be $95. It seems reasonable, but then 95 is actually an incorrect answer, because if you input 95 over here, then it's not the profit you're getting necessarily. Because if you look at it this way, let's say these banks issued it this way, and then you have two investors and they both have $100. Now, the first person, let's say he invests in Bond A. This is a bad decision, because after he invests in, he'll have $0 left to invest, and that $0 cannot grow, even though at the end of the year he might get $15. Now, investing in Bond B is the smarter choice, because the person who invests in Bond B will get $5 left, and will still get $15 at the end of the year. But that $5 during that year, he can put it in the bank, and then that money can grow into more. And if you look at it, the return for Bond B would be more than the return for Bond A, which is why, even though the profit is the same, Bond B is the better decision, because you have more return. So
okay. Another way to look at it is that you can think about as if those are two different products, and Bond A, if you had to pay $100 to get $15, right? Versus the other choice, you only need to pay $95 to get the same $15. Then it's like choice B is cheaper, right? In other words, if you would pay Bond B $100, you would get more than $15 back.
You mean 95?
Yeah.
Right.
Right. Yeah. Okay.
Right. Thank you. So it's not 95, because we've learned that we need to focus on the return, and the return is more valuable than the actual profit you're getting back. So now we must see what is a return.
Right. Can I interrupt you for a second? So I think it's correct to say yes, it's the return that matters. But it is not correct to say return is more important than profit. Those are two different things. They're related. Because return is almost like another way of looking at the profit. If you say profit is good, but it's at what price? Right? If you have to pay a lot to get that profit, that's not as desirable as if you had to pay little to get the same amount of profit. So return is taking into consideration of profit and the price you pay to achieve that profit simultaneously.
Right.
Okay? All right.
Okay. But I also want to mention one thing, is that even though, let's say your price is smaller, but then, sorry, not your price. Your profit is smaller, but then your return may be larger than in another bond where the profit may seem larger.
Right.
So even if the return is larger than another, that doesn't mean that the profit has to be more.
Correct.
So, yeah.
Return is a ratio of profit, net profit, versus the original price.
Right. So, back to what we were saying. Now, what is a return? Your return is the profit that you're receiving divided by the price, and that was exactly what you were talking about. So, we don't know the price for bond B yet. So, let's use the variable P for the price. And the profit. So, what is the definition of the profit? It's what you get back at the end of the year minus the price. And the price is P, but we know what you get back. That would be 110 minus P. So you would put this over P. And then, now what is the solution to this? What does this equal? Since we said that this has to be comparable to this, bond B has to be comparable to bond A, and we know that you get a return of 15%, which is the coupon rate, then we know that this must equal 15%.
And why do we want them to be comparable in that way? Why do they have to have the same returns to be comparable? That's the key point, isn't it? That's the assumption we're using to derive this price, right? In a sense, I think that's the important point to kind of emphasize a little bit here. The reason is that imagine you have, $95, $100. You're going to invest in these two different instruments, right? By the end of the day, you want to make sure that by choosing A versus B, you're going to have the same amount of money back, or there for the return. When the returns are comparable, then given the same price or same amount of original investment, you get the same amount of profit. Right. If one is always better than the other,
then so if bond B did have a price of 95, and everyone will be going for bond B, so bond A will probably be out of business.
Right, and there's no point of having it in the market.
Right. So back to this, we can solve this equation. This equals 110 divided by P minus 1 equals, well, we can take the equivalent of this percent, which is 0.15, and this would mean that 110 divided by P equals 1.15. So that means that 110 divided by 1.15 equals P. So the solution to this equals 95.65.
Okay, so it was higher than $95. So 95 was too cheap.
Right.
Okay.
That's why everyone will be going for bond B, and that's reasonable because that's also logical, because if you think about it, if you have a product that has this price and you have another same product that is a lower price, then obviously the people will be going for the lower price. So
right. For products, as we talked about, let's say ice cream, you might prefer one flavor, somebody else prefers another flavor.
But this isn't opinion. This is just
exactly. This is the fact, the return, and no one was going to settle for less money, correct?
Right.
Yeah. At least that's our assumption.
Right. So therefore, well, actually, the digits keep on going on, but the estimated price for bond B would be $95.65.
Okay, very good. That's a very, I think, very good way of illustrating the process. I want to add one more thing to keep in mind. Ultimately, price of the bond or any financial instrument is determined by the market, right? Supply and demand. If you have more buyers, the price is going to go up. If you have few buyers, the price is going to go down. And it's also influenced by other factors really gets complicated, like interest rate, other asset price, and things of that nature. But so here, what's the purpose of this exercise? It's trying to derive this so-called theoretical price. Because in fact, you don't set the price. If you issue the bond, you don't set the price.
Right. There's actually no way that you're gonna predict the price to be 95.665.
Correct. In a sense, you're saying if you had the two bonds, let's say like that, hypothetically, we had the two bonds, and suppose one bond market value is 100. We know that already. We saw the market value. Okay, this is what is going on in the market. People buying this bond for $100. Okay, then we're saying what would be a fair price for bond B?
Right.
The fair price would be $95.65. In other words, if you were to put this bond in the market, if the market is fair, is efficient, this would be the price you would expect. Correct? And this, in fact, can be derived mathematically.
Yes.
Because the way to derive that is to say, I want these two bonds to have comparable return. Otherwise, one bond will always be better than the others, and then there's no reason for both of them to exist.
Correct.
Very good. Thank you.
All right. Thank you.